Welcome to the Broken Pie Chart Podcast, episode 279. I'm your host, Derek Moore. All right, this week, lots of stuff to cover. We're going to go talk a little Cisco versus Nvidia. Jim Cramer had some comments about it. Wall Street Journal had an article. And I'll just kind of go over my thoughts about this time. Is it different than 2000? Yeah, quick answer, yes, it is. But we'll go through that. Also, all right, I'll keep you guessing for a little bit. Let's talk about Cisco versus Nvidia, though. There was a headline in the Wall Street Journal. I'll link to it, of course, in the show notes. You got to look at the show notes, folks. Nvidia is no Cisco, but it is getting expensive. Chip makers' valuation is nowhere near those seen in dot-com boom. I guess that should be in the dot-com boom. All right, well, whatever. But recent gains have erased the stock's discount relative to its projected earnings. What they did was they went and they looked and they said, they created a graph and it's labeled good times, bad times, share price as a multiple of forward earnings. Remember, the forward PE is just what's the price divided by the analyst estimates for the next 4 quarters ahead combined. So all 4 quarters combined. Cisco's peak, it looks like, topped out about 131.2 times forward earnings. Microsoft's 1999 peak, so that was the 2000 peak, 99 peak for Microsoft, 67.96 times forward earnings. Nvidia, 47.7 times forward earnings. I think that number is, and this was as of June 22nd, just looking here, 42.38 are the forward is the forward PE now on Nvidia. So it's actually gotten a little cheaper. It's not at the all-time high anymore. And I think I've talked about this before, where Nvidia reminds me. I kept saying Intel, but I see Cisco as well, because Cisco is one of those things where, as you know, during the dot-com era, you're going to need. What it is, the storage and the routers and all that stuff, like computer networking products. That's kind of the thing, and it's the back in the day, it was kind of like the picks and shovels of the internet. So today you have Nvidia, and it's the idea, it's the picks and shovels. They make the chips that power the AI, that type of stuff. So I know. Anyway, Intel was the one, and interestingly enough, Intel is a chip company. But I remember when there used to be this magazine, what was it called? Money magazine, or where they devoted the whole issue just to Intel. That's it. And sure, so Cisco as well, kind of the idea, picks and shovels, that type of stuff. Jim Cramer put something out on X. Quote, there's a serious piece in the journal this morning about Cisco versus Nvidia as peaks of internet bubbles. It's cogent. However, pretty much the whole way up, Nvidia has been doubted. The Cisco compare is fatuous, though, because Cisco looked to be 40 times, but turned out to be 100 times, while Nvidia looked to be 100 times and turned out to be 10 times. The estimates were way too high in Cisco's case. I'm paraphrasing. Way too low in Nvidia's case. So, yeah, I think what we've seen happen, and look, I don't know where Nvidia is going to go. I don't try and make market predictions on individual stocks. What I would have seen, though, is that, I think to Jim Cramer's point, as the earnings estimates have risen, we've seen, price has gone up, but the forward PE has come down a little bit because those estimates have risen. And certainly back in the dot-com era, I always, if you ever want to quiz your friends, ask them what the number one weighted stock in the NASDAQ 100, i.e. the QQQ, the Qs, in March of 2000. Think about it for a second. Sirius satellite radio. Imagine that. So, I don't think this is the same as that period. These companies have a lot of free cash flow, a lot of earnings. Again, I don't try and predict markets, but I thought it was interesting that we're starting to see those articles And again, I've been saying Intel, but Cisco, yeah, definitely is a good comparison just because of picks and shovels. By the way, picks and shovels refers to during the gold rush, who eventually made the most money over the long term. It was the people selling the picks and shovels to the gold mining speculators, who a lot actually didn't get rich. But anyway, that's another story. So a couple things I want to go over. One is we're going to be getting into earnings season, and market's been doing well. Market's up year to date. I'll have more to say about that later in some comparisons of really typically what has happened historically when the market's up this much in the first half of the year, because we just closed the first half of the year. June is done from a trading perspective. Monday is July 1st. So I found an interesting chart. This is from Standard & Poor's, Bloomberg, FactSet, UBS. Maybe it's UBS's. I don't know. But what they put out here is percent of market cap and number of companies reporting by week. So you think about if the top 3 companies are all a couple $1 trillion, and really it's July. So the week of July 8th, and JP Morgan, I think usually they're on a Friday with the other financials. That's July 12th. If I'm, that's going to be Friday, July 12th. So you have JP Morgan. I think United usually comes out during that time, but I don't know for sure. Wells Fargo, a couple of the banks. The week of July 15th, you've got Tesla. Okay, United Healthcare is that week. I see it on the list here. J&J, Netflix, and then it's the week of July 22nd. That's when you have Nvidia is not in there, but it's kind of the who's who: Microsoft, Apple, Google, Amazon, Meta, and more. And that week, 47% of the market cap of the S&P 500 is reporting, and 176 companies are reporting. Nvidia is always late. Nvidia is the week of August 12th. And during that week, only 9% of the market cap is reporting versus only 13 companies. So that week of July 15th, July 22nd, and then that Friday, usually the financials are on a Friday in the first week of July, or the second week of July, week of July 8th. That's, we're going to get earnings season again. So it's coming. We're going to have the earnings, and, companies have been reporting good earnings. We'll see what they say. We'll see what they say in the statements, but it's always a good time because it's the one out of the 4 times a year, each quarter, companies have to put it down on paper, and usually CEOs say something, or maybe they don't say something. And there's revenue guidance, there's earnings guidance, and nowadays even we see it on Bloomberg. They look at the earnings calls with the CEOs and the executives, and they see how many times things like AI are mentioned, or how many times staff reductions or inflation is mentioned. So a lot of good stuff there. All right, so we are through 2024. This is from Brian Dietrich. Through 2024, the year-to-date return is 14.9%. In the S&P 500. It doesn't specify if that's total return or not. I guess I could have looked, but the point of his chart here, it's titled, "Don't Give Up on the Bull Market Yet. S&P 500 returns after a greater than 10% year to date at the middle of the year." That's where we are right now. And so 2024, 23, 21, 19, the most recent years. And this goes back to, it looks like 1950. And what you find is, on average, over the next 3 months, markets are up 1.5%. The median is up plus 2.2%. And the percent of times higher over the next 3 months, 65.2%. And then you go the rest of the year. So from Monday on through the end of December, the average, again, when the market's year to date through the first half of the year are up greater than 10%, the average is up 7.7%, the median up plus 9.8%, and and that's the rest of the year. So it's already up more than 10, and then what's going to happen the rest of the year? Or at least with this historically, we have no idea what's going to happen, right? That's why we hedge. But percent of the time that's higher, 82.6%. And there hasn't been an instance going back to 1950 where the market has wound up lower in a full year cycle. 1987 was the lowest, is the only one that's not in double digits. That was up 2%, which is crazy to think. The market at one point was down quite a bit and then rallied back from the October lows, the crash of 87. So what does that really mean for the rest of the year? I mean, I don't know. I think the point of this and what his point of putting this out is just because markets are up doesn't mean they're not going to be up the second half of the year. And we know markets most of the time are up. And more often than not, they're up. The degree that they're up is different. But I think, if you're someone who is a bull and you're saying, no, I think this has more to run, this is some pretty good evidence. Again, we don't know what's going to happen. And I think there's a really good case here. I mean, this is an example of rather than trying to pick tops and bottoms, you stay in the market, you keep some hedges on the portfolio, and that way you sleep a little better at night. Because in the end, you just don't know what's going to happen. All right. So I thought that was interesting. And the other thing I looked at is, anytime we have a new month, we get some stuff that comes out. I think this is also from Ryan Dietrich. He's put out some good charts lately. July is the best month the past 20 years. And this is the S&P index average monthly returns 1950 to 2023. So they've got since 1950 and the past 20 years, past 10 years, and then in an election year. And yeah, if you look at over the last 10 years, July has been the best. Over the last 20 years, you know what? November, and I can't really read the scale, but November and July are pretty even. And then since 1950, there's too many bars for me to take a look at. So, all right, well, take that for what it's may. It doesn't mean that every July is up. They don't have the numbers there. And during election years, July tends to be up. And you know what's interesting too? I'm peeking at August, and August since 1950 has been a little under flat. Past 20 years, little under flat, little above flat for the past 10 years. But election years tend to do pretty well, and September is the one that typically that's lower. Again, you don't know if it's going to be low. It's not always low. But so I thought that was an interesting data point to take a look at. Remember the old thing. Everyone says, oh yeah, sell in May go away. And I won't get into that because we're past May, we're coming into July. But, there's research that kind of says, well, you might have missed out. That's why you hedge. All right, a couple things that I find interesting, and I don't think we've ever talked about the French stock market index, the CAC 40 or CAC index. And I won't even go into I'm underqualified to talk about French parliamentary elections, but President Macron decided to do a snap election, and it's the parliament that is up for election. They do things a little bit differently in Europe. He is still the president, at least for the next 3 years, regardless of what happens. But I saw this chart on the Daily Shot, and it's the 30-day implied volatility at the 100% moneyness. What is the difference between the CAC 40 index in France and the DAX index for Germany? And, the implied volatility at and all right, so here's a little, kids get the notebooks and the pencils here. When you see moneyness for options, when they're talking about, at 100% moneyness, it sounds complicated. It's really not. So think about if a stock is at 100, and I'm using 100 because it'll be easy to do these percentages up and down. Well, the 100% moneyness option would be the 100 strike, the at the money option. If we had a 110 moneyness option, 110% moneyness option, what would that be? It would actually be the 110 strike because it's 10% above the market. It's 110%. If we were looking at the 10% Below the market strike, we would say that's the 90% Moneyness strike. And that would be the $90 strike. Easy to do when it's 100. Tougher to do in your head when it's 738 is the stock price. But anyway, so you're looking at the at-the-money options. 21.6% is the implied volatility over the next 30 days, and the DAX is about 14.3. So, and you can't see this chart, but most of the time, they pretty much trace each other. And you would think that's the case. But basically what is being reported as the President Macron's own party probably is going to lose seats, which could affect his ability to get stuff done that he wants to do. I'll stop there because I'm no expert on the French Parliament, but there's some implied volatility. And you see this with elections, and markets generally don't like uncertainty. So if I ever dig it up, I should probably look it up, because one of the best examples ever of implied volatility spiking in front of an election was when Quebec was doing their election to see if they were going to secede from Canada. And the Canadian dollar, the implied volatility in the Canadian dollar had gotten really, really high right before that election. Okay, but there you go. Now you know what moneyness is when people say, 100% moneyness, 110% moneyness, 90% moneyness. Sounds complicated. It's not. It's just talking about where the strike price is relative to the stock price. And that's for calls or puts. So if you bought a 90 moneyness call, it's 10% below the market. If you bought a 90 moneyness put, it's 10% below the market. All right. Enough of that. So the other thing, inflation came out last week. It was rather muted. And of course, we've got CPI. That was PCE, right? So PCE came out, which of course is the Fed's preferred gauge of inflation. And the one I've been watching is, of course, the PCE, the core services, less housing. So this is just services, less housing, not goods. That's still 3.4% year over year. And we've seen goods fall off. I mean, goods inflation has kind of dropped. Services has been more sticky. And we see this in things like medical costs and stuff like that. But I don't know. I mean, everyone is hinged on this whole, when's the Fed going to lower? I can tell you the implied Fed move based upon the Fed funds futures would put a first cut in November. And I don't think it prices in a second cut fully until, I should have had this up here. Let's see. Yeah, I mean, I think January is when they would price in the second cut. December's close. It's the way these work is they sort of had the implied number of cuts from today. So minus 1.016 is the November number, meaning it's implying a full 25 basis point cut. December is minus 1.7, meaning not quite two cuts. So, and then January is minus 2.28. So basically it's saying, two cuts there. Okay. So, we'll see. I'm sort of tiring on this, but as Jay would point out, the fact that the market is still talking about rate cuts, it's almost like the more that everybody expects rate cuts to happen at some point, the better it is maybe for the market, because it knows something is coming at some point. That's the assumption, unless inflation were to reignite, which wouldn't be good for anybody. Okay. Well, let's talk about that though. And everyone knows here, and I know you love the container shipping talk. Well, it looks like container shipping is at the highest cost, and this is the Drury 40-foot container box. That's what they load up onto the container ships. If you look at those, or if you look at a train car, that's what it is. So right now, it looks like the cost is $5,318. It's been rising. It sort of rose in January, came back down in April, and then rose back up. but it's actually the highest cost per 40-foot container box since September of 2022. Does this mean inflation is going to come back? And didn't you tell me that goods are sort of moderating? Yeah, this is just something to watch. And there is some correlation between the CPI and this. I haven't run that correlation or that chart in a bit. I'll have to do that again for a future show. But yeah, I mean, I take a look at this, and you don't want the cost to ship goods to be going up like this, because you can understand if you're somebody who is shipping goods from other parts of the world, let's say from Shanghai to the US, and if things are manufactured and then they're shipped in a shipping container and they come over here, well, if it costs more, either companies are making less or they got to raise prices. The other thing of this is, I haven't looked at the inventory, and I haven't looked at if there's any extraneous reasons for this, meaning is there less inventory because ships are getting repaired? I do know that they're still going around the long way. They're not going through the Red Sea and the Suez Canal because of the troubles there. And when it takes longer for one of these ships to get from point A to point B, they don't get to turn as quickly. So, that is taking inventory out. And maybe that's the answer. Maybe it's the Occam's razor answer, where the most obvious thing is, in fact, true. So we'll keep an eye on that. I keep watching these, and even though people make fun of me sometimes for watching them, that's okay. All right, so something else. By the way, the CAC Courant, I forgot to mention this. That index is down 9.23% off the high, and the high was probably in May. I don't know if that coincided when Macron announced the snap election for Parliament. I don't know. But just keeping things international, another data point or thing that hasn't happened since 1986. Can you guess what it is? Anybody? Okay. Japanese yen. The Japanese yen is the weakest it's been since, it looks like, maybe, actually, you know what? Maybe this is 90. Maybe I'm seeing that. It's either 86 or 90. It's close. It's very close. But regardless, and unfortunately, 86 and 90 is getting further and further away as the older we get. But it is pretty weak. So if you look, and let me see here. There's a way. I wanted to invert this. How do I invert this? Hang on. I know you're waiting with bated breath here. All right, there we go. So last price on the yen against the dollar. So basically, it's how many yen do you need to get $1? It's 160 yen now. 160 yen. So the yen is getting weaker because it's taking more yen to get that same dollar. To give you some perspective here, if I go back to 2011, it was only 77 yen and change to get $1. So the yen is getting weak. And I don't, the reason why this matters is, one is we think about demand for, Japan doesn't have a very big manufacturing sector. So it's not like companies are really making out, U.S. companies are making stuff really cheap, but it does have ramifications in the sort of the global economy. We'll have to watch this. I don't know if there's anything yet. I don't think we've seen anything that really would say, oh yeah, it's the yen weakening. But without boring everybody or all of our listeners, I'll kind of leave it there. But it's just a thing to watch. It's definitely a thing to watch, and we'll keep an eye on it. And then finally, another thing I've been keeping an eye on are oil prices. So oil prices had gotten down to, let's see, in May. Actually, no, this is early June. They had gotten, this is West Texas Intermediate, which is the CL futures contract, the crude oil futures contract. And this is the active first month. So about 73.25 was the low. It's sitting at 81.54. But it's up off the low, and it's probably up in June from the end of from May, probably 5 to 6%, just kind of eyeballing it here. So this is another thing where you think about input cost and profit margins. If oil were to make another run, and I don't know if it is or not, I don't try and make predictions there, but you would say that this is something that is an input cost, just like shipping containers, just like all that stuff. And it's something to watch, because if you saw a material increase in oil prices, and that would be in the CPI, of course, core excludes energy and food, supercore excludes energy, food, and housing as well. So, it's risen. It hasn't it hasn't passed the old high, the most recent high in April, which is about 86.91. But we'll keep an eye on this because it is an input cost and it matters for the economy. Okay, I lied. One more thing. Let's talk about the dollar. So the dollar recently closed, the dollar spot index, 105.87. That's rounded. And its high was 114.10 in September of 2022. Now, those of you who are longtime listeners remember me talking about this. A strong dollar can actually hurt U.S. multinational companies. And the reason is because their earnings are always reported in U.S. dollars. So if you sell a widget in, let's say, Europe, and the dollar is getting weaker and weaker and weaker, you might sell that same widget. But when you convert the U.S. The euro back to dollars, even though it's the same sale and maybe the same price, it actually lowers the amount of dollar revenue and dollar earnings that companies get. And that's why in 2022, you heard companies on their earnings calls talk about, well, dollar adjusted revenues or dollar adjusted earnings. Or I remember there was one of the Magnificent Seven who said the strong dollar basically took away about 6 to 7% of our net income and our revenues in a quarter. So it's not, if you could see the chart, it's been in a bit of a range. We're at the higher end of a range that we've been in, since the start of 2023. It had been going up and up and up. It came down. This is another thing that I'm watching. And part of what drives the dollar is relative interest rates. And so we know that Europe has, I believe they did one cut, or they said they're going to do one cut. I should have looked that up. There are some other countries that maybe might start cutting, and interest rates a lot of times will drive the value or the exchange rate of a currency versus another currency. And the idea is you go into one currency, you can earn for example, the carry trade. You get long one, you get short the other, and you make the carry, the difference between what you pay on the short side and what you earn. And by the way, folks, I'm not suggesting you should start trading Forex. Please don't do that. That's a lot of leverage there. But this is important, and it's also can be important for earnings. So something to watch as well. I feel like last week we were a little too bearish, both on the economy and, we said, let's maybe scare some people. This week, hopefully there's a little more balance, but just things I'm kind of watching in there. And despite all of that, the markets have been strong. Earnings estimates have been going up. And at least right now, nobody's saying that the Fed is going to raise. The question is, are they going to cut and when? And, if you listen to the talking heads on CNBC, I think a lot of them feel like, we're 5.25 now. They could see us maybe getting to 4, maybe down to 4.25 at some point over the next, year and a half. Who knows? They're always wrong on this stuff. And by the way, don't listen to the Fed. Really, their dot plot predictions are awful. So, all right, that's it for this week. We'll be back next week with another episode. Always send emails and questions I do have some questions that I've been meaning to get to. I'll try and get to those next week. Derek.moore@zegafinancial.com. That Z is in zebra, E is in Eddie, G is in George, A is in Apple. Financials up to you to get correctly, spell correctly, and .com. You got to get that correct as well. If you want to reach me on email, send me questions, comments, all that stuff. We always like to hear from listeners. All right, that's it for 279. Oh yeah, The Bear is back. So The Bear season 3 on Hulu. I only watched the first episode. It's a good series. If you haven't watched it before, go ahead and watch it on Hulu. I got to figure out how to get rid of the commercials. Like, they got me. I'm just going to pay the extra, whatever it is, couple dollars a month to get rid of the commercials because it kind of gets annoying watching it. But The Bear, it's not as good as Succession. It's a different show. It's about, people in a restaurant, but the acting, especially season 2, there were a couple episodes that were just, really, really nonstop. The dialogue and all that stuff. So I'm looking forward to, I've only seen the first episode of season 3. I'm looking forward to finishing that. So that's my recommendation. I'll put a strong buy on The Bear. How's that? All right, that's it. I'm out of here. Goodbye. See you next week.